Hello guys, welcome back to the channel. Today we're going to be starting a new kind of thing and it's going to be more down the investment lane on the channel. We're still going to be going with cryptocurrency. As we know, we're heavily into crypto mining and the crypto markets as a whole. So obviously that comes into an asset class of investing, but I want to go down a simpler route, more into investing concepts or just the basic fundamentals behind it, just to give new viewers some information and just basically teach people more about investing their wealth and what it means to basically grow your money and to hedge against inflation. Because at the end of the day, as we'll explain later in the video, that's mainly what you're supposed to do with investing, is beat out the inflation and have a little bit of profit on top. So if you enjoy the crypto mining videos, this will be probably enjoyable for you if you don't know much about investing. Obviously, cryptocurrency mining has a lot to do with investing, in hardware and stuff like that. But mainly we're going to be looking at just the fundamentals behind investing and mainly just displaying my process behind investing and the whole, ethos of what I would do if I was in the same position as anyone that was younger than me or older than me. So obviously not financial advice, but we're going to start off today with just dollar cost averaging, explaining it very simply. For those who have not invested any time before, this is one of the most basic concepts. And as you can see here, quick little image, an approach to purchasing an investment in which the buyer spreads out their purchases so that the total price paid is less affected by the market timing. So there's this famous quote about time in the market and time in the market. So it's better to have a lot of time in the market than try to buy into the market at certain lows or highs. So this is why dollar cost averaging works out. Overall, it's less risk, but it still produces pretty good results. So we have a dollar cost average calculator here. It's not going to be entirely accurate to the actual stock market or anything like that. But as you can see, we have just the S&P 500 up here. So this is if you invested $1 at the start and then every month. So what you would do is you take your paycheck or any money that's coming in and you'd invest that on a certain date at a certain time. Every month. You can even do it every week. Every week would give you a better average price. Every month, obviously, people utilize that as well. It'd give you a slightly less average price. Every year would be slightly less average, and so on and so forth. For example, you could do it every day to take advantage of, price swings in the market. For example, with things like Bitcoin that goes up and down, or any cryptocurrency that goes up and down a lot, you maybe want to dollar cost average every day instead of every month, just because it moves up and down so quickly. It's a little bit different for just overall stock markets because they don't move as quick as you would see in a cryptocurrency market. So maybe you dollar cost every week or every month if you are in the stock market. As I said here, we have the example of kind of what we're looking at in terms of dollar cost averaging. Initial investment is $1 and then recurring investment every month. So this is if you put $1 every month for the next 10 years, basically. As you can see there, total amount invested, $122, and then the total gain is $136.87. Overall final value would be obviously the total amount invested, plus the total gain gives us the final portfolio value. So you have a percentage gain of around 112% if you dollar cost averaged out into the S&P 500 for the last 10 years. So you can see how you can quite quickly grow your money at a lower risk. It's not a substantial amount of money. Obviously, it depends on how much you put in. For example, if you put in $12,000, it would then be worth around $25,000 or $26,000. So you can see how over time, it really depends on the scale of money you're working with. But we've just chose this because it's easy to show $1. And then right here, as we're going back to our roots in cryptocurrency, you can see Bitcoin as a hedge against inflation. So this would technically be classed as a hedge against inflation if you were putting your money into this, and we'll go a little bit into that later on in the video. However, dollar cost averaging here, as you can see, we've done the same thing, $1 every month for the last 10 years, so 2014. And if you had done that, your initial investment would have been 122 again, and final portfolio value would have been 5,733. So what does it mean by this? The percentage gain is way higher, obviously, but a lot of people didn't really know about Bitcoin until around 2018, 2017 when we had that massive bull run. So you can be very early, but I doubt that a lot of you will have the experience or the knowledge to know when you're early into something. It's very rarely that you pick up on that. Cryptocurrency has kind of opened that up because you can get into coins very early and quickly. With stock market investing, you don't necessarily get to invest in these smaller companies or smaller businesses just because they're not really out there for trading. So this is why I think that cryptocurrency has been great over the past 10 or 13 years, because you can basically invest into anything at zero value. Normally, when you see something on the stock market that's new, it already has value from other investors and they've chosen to go public on the stock market. So cryptocurrency has opened up a different lane in terms of investing, and there will be further videos on this, but we're just covering dollar cost averaging today. So you can see how through Bitcoin, you've hedged against inflation quite a lot. So if the inflation for the last 10 years amounted to, 100%, let's just say, that means that the percentage gain would still be, 4,400, something like that. So basically, if you invested kind of any amount of money that you would have here over the past 10 years and you dollar cost averaged it, so every month you put in $10, let's just say, that means that probably by now you would have had around 57,000 if you had put $10 in per day. So the initial investment would be about $12,000, and then the final value would be around 57,000. So you can just scale these numbers up and get an idea of kind of how it works for dollar cost averaging. So it eliminates the risk. There are obviously, with cryptocurrency, best times to buy, as you can see on this chart. But when we look at the S&P, there's not really any best time to buy. You're better off going with dollar cost averaging over the time period right here, because it's a pretty linear line that you can track going upwards here. With cryptocurrency or Bitcoin, it is a bit up and down. And that's why I said you should dollar cost average every day or maybe every week, and then reserve monthly dollar cost averaging for stocks or the stock market as a whole, S&P 500, or even a global tracker mutual fund. So we're taking this same figure again, just ignore the fact that it's in pounds. It can be in dollars, it's just the displaying figure. We're talking more about the numbers here instead of the actual value of this, so it can be in dollars. So we just typed in simple calculation, show me how much $122 in July 2014 is equivalent in today's money. Now these figures might not be super accurate, so they might be accurate to a factor of 0.5% plus or minus each way. And it says here the cost of goods and services have increased by 51.5% over this period. That means that your 122 would have grown by an average of 4.3% per year. So that's with inflation added on, so that's how you get this 185 figure. Just to have kept pace with inflation, that's what it needs to have grown to. If you've achieved a lower rate of growth, the real value of your money would have fallen. So if you have money stuck in a bank account or it's sitting there saving, you're basically going to lose 4.3% per year. So anything above that is technically classed as a gain. So this is the reason why people invest, is because they need to outbeat the inflation firstly, and then anything on top of that is kind of classed, in my opinion, as what your real net gain would be. So you've got to take away inflation. So you have to be beating inflation every year, which is not exactly too hard, because if you look at this over the past 10 years, you can see an average of 43% or 51% here. And then if we go to our dollar cost averaging, your percent gain within those 10 years is 112%. So you'd minus around 43% to give you, maybe 60%. And that's what your actual gain is after inflation. So remember, it is inflating all the time, which means that you have to outbeat that. And that only gives us a kind of 65% maybe gain over the past 10 years. If we take it back to Bitcoin, obviously we outdo that by quite a lot, but we've already previously said about how this asset class is new and you get to invest in it quite early on. So that's probably why, you see more gains from here. So the reason that people invest and they don't save money and put it into a savings account is because normally we don't see those high interest yield savings accounts, and you normally have to fish around for them and look for them. If you're banking with major places, they're not really going to have an interest rate above 4.3% from what I've experienced. There might be obviously bank accounts that do offer it, and a lot of people might have researched into that. However, just the big ones, if you can see here, many online banks have saving interest rates higher than the national average savings account, so online banks. The higher the rate, the more interest you'll earn on your savings. The national average savings account yield was 0.59% APY. So that's per year, which means that you're basically nowhere near this 4.3% per year. So you're not even close to outbeating inflation, which means that your money is decreasing by that percentage per year in purchasing power relative to anything else on the market. So just to put it in basic terms, food will be increased in price, but your money won't increase. So that means that you'll pay more for that food than the money that you saved. And then if we look at APY comparisons, I believe that these are a couple of online banks, but if you look at the big ones right down here, you have Chase Bank, US Bank, Wells Fargo, Bank of America, offering basically 0.01, which is, as again, nowhere near this 4.3% to beat it per year. And that's the reason that we dollar cost average, or at least invest into the stock market or any type of asset class, is because you want to outbeat inflation. And then once you outbeat inflation, anything on top of that is kind of classed, in my opinion, as I said, as your actual gains. So over time, over this last 10 years, if you started saving from 2014 and you put it into a bank account and it had a 0.01% interest rate on top of it, you would basically be decreasing the purchasing power of that money by 43% in today's terms. So it would have been worth 43% more back in 2014 than it would be now. So that's a very basic overview of how you can invest and what dollar cost averaging is. The reason that we dollar cost average or get into the market is one of the simplest ways to actually invest. Now, it might not be the most increase, or it might not be the most amount of money we can extract from any type of investment. However, it's one of the safest ones that we can go with. So if you're young and you're thinking about saving money, I know everyone says about saving money, it might also be better to look into dollar cost averaging into any type of, a mutual fund that just tracks the S&P, or maybe a global fund that tracks kind of top 100 global companies. That could work out as well, just because you want to grow your money with inflation and earn a little bit on top of that whilst you decide what you want to do with your money. Normally, younger people aren't going to be, younger people, they can't really buy houses and stuff like this. And the reason is because they're getting crushed by this inflation that's happening. So what you want to do is at least preserve wealth, and even better, build a little bit more wealth from investing into these things. Now, as I said, this is just a quick overview of dollar cost averaging and why you would invest in the stock market overall. As I said, there'll be way more videos coming out on the channel. Hopefully you guys like this one, and if you have any questions, stick them in the comments below. Make sure you like the video and subscribe for more content like this.